Hello, hello, everyone. Welcome back to Signal or Noise. Happy New Year, everyone. First episode of 2026, episode 66. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, start of each year, we get a million questions. We're going to do our annual questions episode here. 6 questions for 2026. Let's start out with question number 1. A lot of people asking this. Will international stocks lead again? Not a question we've had many times in the last few years. In fact, it's the first time, because for the first time in a long time, we saw unbelievably strong international outperformance. What I'm showing you here is MSCI Europe up 36%, emerging market stocks 34%, US stocks still pretty good year, 18%, but this was the biggest gap that we've seen. You got to go all the way back to 1993. It was a 15% outperformance for the MSCI World ex-US index over the U.S. stock market. Biggest outperformance and the best year for international stocks, Peter, since 2009. So before we talk about what can this continue, will it continue, what do you attribute to this happening in 2025? A lot of different explanations after the fact. What do you think was the big reason why we saw this outperformance?
I think what's interesting is I don't think there is an explanation. So if you look at going all the way back, 2000 to 2010, U.S. stocks earned 0%. The S&P 500 return for that decade was 0%. Absolutely shocking. International emerging markets, real estate bonds, all had an incredible decade. So then we went into the new decade and everyone was pleasantly surprised. Everyone was like, oh, I'm just going to invest overseas. The U.S. is dead. Emerging markets is where it's at. And from 2010 all the way for the whole decade, S&P 500 crushed everything, largely because of the tech revolution. These companies, big companies getting so big, but just U.S. stocks just did generally better. So we get to the next decade, 2020, we're going into 2021, and all the predictions, Goldman Sachs, BlackRock, Vanguard, everyone's like, hey, the international had a decade, the U.S. had a decade, we're going to rotate back to international, the dividend yield's better, the PE ratio's better, every major metric is better. So international emerging markets is where it's at. And for the first 5 years of the decade, that was not the case. Just large U.S. just kept outperforming, which is crazy because we know that small cap is supposed to do better than large cap over the long run. And overseas in the U.S. should do about the same over the long run. And emerging markets has a higher growth rate and should do better over the long run. And we just didn't see that for 15 years. And finally, just on a dime, the rotation started at the beginning of last year, and international stocks absolutely trounced the U.S. For the first time in a long time, I'm hearing my clients say, why am I not all international? Why don't I rotate all international? International is still trading at a steep discount to the U.S. Why am I not there? And the answer is because we have no idea what's going to happen in any given year, which is why we've got to have money in both places.
So let's talk about this other question in terms of, can it continue? So often after a big move, Peter, you hear people say, am I too late to the party here? Is it too late to diversify international if I'm not there already? I'm just going to show you 2 charts that would illustrate that perhaps this could have legs, maybe not in 2026, but in the years to come. One would just be looking at the ratio of U.S. stocks to international stocks, which peaked at the end of 2024 at 3 standard deviations above the mean. But even after that huge outperformance in 2025, it's only just a blip here, right? Because we had 16 years of U.S. outperformance. So certainly on that basis, you could see it continue. And here I'm showing you rolling 5-year returns for U.S. versus international. And still, if we're looking at any time period longer than a year, basically, Peter, we're still seeing U.S. outperformance. So it's 15 years now of rolling 5-year outperformance for the U.S. stock market, which is by far the longest in history. So I guess the best argument I would say that this could potentially continue is this is still the early stages because it's such a big outperformance that has come before it. And there's still a pretty wide valuation gap. So here we're looking at the CAPE ratio between the US and European markets. US, we know, is near the highest level since 2000 at 39 times. And European markets still relatively cheap here at 22 times. What do you make of all this? Could you see this? Would you be surprised, I guess is the question, if international outperformance would continue, maybe not in 2026, but in the next 5 or 10 years?
Well, I wouldn't be surprised either way, because basically what we're seeing is European stocks, to your point, they're a better value. That's the bottom line. They're a better value right now than U.S. stocks. That was the case last year. It's the case the year before last year. It's the case before the year before last year. So just because something is a better value doesn't mean that in any given year it's going to outperform. But like, look, if somebody's asking me, where's the better value? It's obviously in Europe, but you can make a very big and solid argument as to why that is. Europe has become much more socialistic. The tax rates are extremely punitive in some of the countries. The social support network that they have for the immigration issues that they've got in Europe is putting a tremendous amount of pain on a lot of European countries. We've seen a couple countries borderline collapse, like Greece. Some people are basically refer to Europe as a museum. I don't share that sentiment, by the way, but I mean, it's very different than a world where some guys tossing around an idea for OpenAI and now the company's probably worth $1 trillion, right? There's just a lot more innovation, a lot more capital formation, a lot more money behind ideas in the United States than anywhere in the world. So you can argue that that discount in Europe exists for a reason, that it's supposed to be at a discount. But bottom line is, I think both markets are relatively fairly valued. And so it just wouldn't surprise me either way.
Yeah. Ultimate question investors will have to answer this is the discount too much? Is an 80% discount too much given all of those facts? Let's go to question number 2 here. Will the average stock catch up? So, unlike international, Peter, which saw this epic reversal in 2025, we did not see the same for the average stock in the S&P 500 or small cap stocks. In fact, we saw the S&P equal weight hit its lowest level on a ratio basis since 2003, so over 20-year low in terms of relative strength. And if we look at the S&P equal weight, this is going to be an interesting stat for people. The last 3 years, it has trailed the overall S&P 500, which is cap weighted by 34 percentage points. That is the biggest 3-year underperformance for the equal weight in history. The prior record was 1997 to 1999. And following that, equal weight would outperform for 7 straight years. Small caps, as we know, long overdue for a reversal, Peter. We've been waiting, talking about this many times. In 2025, it did not happen. We saw the ratio of large to small hit its highest level since the 1999 peak, almost a record high. And we saw small caps underperform for the 5th straight year. Only other period in history where 5 straight years small caps have underperformed, 1994 to 1998. That was followed by 6 straight years of outperformance from small caps. So a lot of things there, Peter, suggesting potentially we could be getting close to that reversal that we've been talking about for a long time. What do you think?
Here, I think, I don't know if it's going to be this year, but there is a reversal that is going to happen here. And when it does, it is going to be fast and furious and leave people's heads spinning. When the Russell 2000 decides it's going to move, it tends to move very, very rapidly and a lot, up or down. It tends to move a lot. It's not been a friendly world for small caps. We saw interest rates rise over the last few years. We saw a lot of the AI revolution happen in large cap stocks. Of course, the higher interest rates impacted smaller companies because they are more susceptible to the strains of the debt that they carry on their balance sheets. But if we see a small cap run, especially if rates do go lower, I think it could be very, very dramatic, much like we saw overseas with small caps or with international stocks in general.
Yeah, and I think the best argument, similar to that international and U.S., is just looking at the valuation gap. Nobody is pricing in or expecting small caps to do well here because there's a big valuation gap. Large caps near their highest levels of valuation since 2000. Not true for small and the equal weight, the average stock in the S&P 500. And in terms of diversification, Peter, people often ask, well, why should I continue to own these things? Well, international would be one example in 2025. Why should I still own other areas within the U.S.? I think there's an argument to be made here that there's never been a more important time to maintain that diversification within the U.S. because of the concentration within the S&P 500. Top 10 stocks in the index hit another record high last year. 39% of the index now in just 10 stocks. Does that resonate with you, that argument?
Yeah, I mean, this is now getting truly incredible. I started to pay attention to this a lot when the S&P 500 became when 25% of the S&P 500 market cap came from just 10 stocks. Now we're at close to 40%. It is not impossible to imagine a world where half of the market cap is just 10 companies. I think we are heading there. If you start to look at how these companies just have built-in inflation hedges, like Apple, every app on every app there, they're taking cut of, prices go up, they're participating in that. I mean, it is incredible. So somebody can own the S&P 500, think they're diversified, and really they've got a very big AI bet inside of a tech bet, inside of a US bet. You have to own other things to be diversified. It's not just the example, which is a great example, that international crushed the US last year. It's that things can go bad in the US and have it be possible where things go well somewhere else in another asset class entirely. It's good to spread things out. You look at wealthy families, that's what they do. And I think it's a lesson for everybody.
All right, so we'll see end of 2026 if this is the year we see this reversal. It wouldn't be shocking to me or you, but I think it would be shocking to a lot of people given how long large cap growth has dominated the markets. Okay, let's move to the Fed. Big question: how many times will the Fed cut interest rates? I'm asking how many times here will they cut, Peter, because absolutely no one's saying they're going to hike rates. So it's not even a question. It's just how many times will they cut? Let's review what they did the last 2 years. 2024, they cut 100 basis points. 2025, last year, they cut 3 times, 75 basis points. So 175 basis points of cuts so far. And what is the market expecting heading into 2026? Well, they're expecting 2 interest rate cuts in 2026. And that's not a lot if you ask what the president is calling for. He's calling for much, much lower interest rates. So I think that would be a big disappointment to him if we only saw 2 interest rate cuts. So my belief, Peter, I want your take on this, is there's going to be a big fight within the Federal Reserve. Trump is saying the next Fed chair will believe in lower interest rates by a lot, which means there's a litmus test. And Kevin Warsh and Kevin Hassett clearly making statements that they both are big believers in much lower interest rates. They want that Fed job. And maybe for the first time in a long time, you're really going to have Fed independence questioned, but also you're going to have a fight within the Fed because this is just one individual. This is the Fed chair. And there's another 11 voting members who might not see eye to eye. What do you make of all this potential interesting turmoil that might occur within the Federal Reserve?
I mean, every president wants lower rates because lower rates usually mean a stronger economy, higher employment, better stock market returns. People tend to be happy when their 401k is up and they have a pretty secure job, and they tend to re-vote for whoever's in office. I remember when the first President Bush had the highest approval rating in the history of U.S. presidents at the beginning of the Iraq War. Note at the beginning, not at the end of it. The highest approval rating ever recorded, and he lost his reelection. And he blames the Federal Reserve chair because they raised interest rates. We went into a mild recession, and that was it. I think presidents really care about interest rates. Now, you don't normally see very, very low unemployment, strong stock market returns, a housing market that's out of reach for many Americans, and somebody pushing for lower rates. That's usually not the base case for lower interest rates. Obviously, President Trump just wants to see the economy on fire and isn't concerned about the inflationary element of that, which is why he's campaigning. So we now have basically Federal Reserve chairman candidates actually campaigning in a not so subtle way. So much for the independence of the Fed. Where rates go, I have no idea. Even with all these indicators, the there's too much variability with everything else going on in the world to know what's really going to happen here.
Yeah, your best guess, or my best guess, would be they are going to cut because they usually, when they start cutting, they can continue cutting, and they made it pretty much clear, Peter, in 2025 that they're going to ignore this inflation picture, like pretend that it doesn't exist. Essentially, I mean, we've seen the CPI inflation in the U.S. double their target. So the Fed has a 2% inflation target. We've averaged 4% annualized since January 2020, so almost 6 years of double their target. We're not in a recession, as you stated. Economic growth is reasonably good, around 2% overall. And we're talking about easing monetary policy. Well, that to me is sending a message to the markets. We don't really care about this 2% target anymore.
I would agree. And if you made me bet, I would bet on a couple of cuts. But I mean, we've been here before. You just never know what's going to happen.
For sure. The one thing I'll predict is I do think there's going to be that battle within the Federal Reserve, with some people holding the line in terms of saying inflation still matters. We can't go down to 1% or 0% as fast as you think here. And so there's going to be an internal battle, which will be very interesting to watch within the Federal Reserve. Number 4 here, will national debt hit 40 trillion? I don't like to make many predictions, Peter, but I think this is probably a pretty easy one.
Here's why. This is one where you're very, very comfortable predicting. I mean, I will predict we'll hit 50 trillion. I mean,
no, I mean next year in 2026.
Yeah. Oh, yeah, 2026. Yeah, for sure, 40 trillion. I mean, there is no restraint here at all in terms of spending. We have record deficit spending, expanding entitlements, talking about a $1.5 trillion spend on the military. This is insane. Racking up the credit card debt for another generation. I mean, this isn't a conservative Democrat thing. Biden was a total train wreck when it came to increasing the deficit, and Trump has been an even bigger train wreck at increasing the deficit. I mean, we're talking, absolute drunken sailor spending as if there is no consequence to it whatsoever. Of course, we know there is. It's going to be very significant when we get to a point where we just can't borrow at the rates we need to fund this debt. This is a really kind of an unfolding tragedy here across the two most recent presidents, and there is no sign at all under President Trump that, in fact, this is going to accelerate and get much worse. If you look at him, he wants lower rates, but but what he wants besides that is he wants to lower tax rates and he wants to increase spending. It's just it's like if you're pulling every lever you can to make this worse.
Yeah, so the recent headlines just came out today. $1.5 trillion in defense budget. Obviously, that has to be approved, and Congress will have to approve that increase. But that's a big number, because that would mean a 50% increase. That would almost guarantee, Peter, that the deficit doesn't shrink in 2026. Just to put the numbers to it here, we ended 2025 at $38.5 trillion in terms of the national debt. That was a $2.3 trillion increase from where we started the year. If people remember the show we did after the passage of the big beautiful bill, we talked about the debt ceiling being raised by $5 trillion, and now they've almost already eaten up half of that, which to me means there's going to be another fight about that ceiling. Probably by 2027, we're talking about 41 trillion is the new ceiling. It's probably going to be hit in 2027. So unfortunately, as we've said many times, it takes a crisis for them to do something about it. And we're not at that crisis level just yet. And we're going to see it when it comes in terms of the bond market, in terms of interest rates, where they simply can't control it anymore. But my guess, Peter, and I don't know what your take is, at that point, the first thing that they will be calling for, and probably will happen even before we get to that point, is for the Federal Reserve to step in and start doing quantitative easing rather than cut back in terms of spending. We'll just want the Fed to go out and buy those bonds because the market isn't able to sell them.
That's right. But all of these things are kick the can down the road solutions. Ultimately, you have to have a balanced budget at some point to get your way out of this mess.
Yeah, and in terms of, you mentioned the tax side of it, Peter, we haven't yet seen the revenue decline or projected revenue declines, because many of the new tax cuts that went into effect under that big, beautiful bill, really you won't see it until 2026 when people adjust their withholding. They get tax refunds, so that will be something to watch as well. We're not only just seeing potentially increasing spending, but perhaps, and that will depend, of course, on economic growth as well, but perhaps seeing a decline in the revenue side as well, which of course would just worsen that deficit picture. Okay, let's talk about number 5 here. Where will the S&P 500 end the year? This is a game that Wall Street loves to play. They almost always get it wrong. They got it wrong, of course, again last year. Better than 2023 and 2024, though, Peter. In those 2 years, we saw the S&P 500 end the year above every single one of the strategist forecasts. Last year, there was a few. that were actually higher than the S&P 500, but at 68.46, it ended the year about 200 points above the average target. So they were still a little bit too bearish for 2025. This year, I'm showing you here a table, all different projections. What's interesting, Peter, is this is the most bullish they've been in quite some time. They're actually expecting on average an 11% gain for the S&P 500, with the S&P 500 ending the year at 7,600. Why don't we play this game of predicting where the S&P 500 will be at the end of the year?
I mean, this is crazy because the odds the market will be negative in the coming year are 25%, right? Any given year, that's about what happens. 100% of these analysts expect the market to be higher over the course of the year. Like, look, no one knows what's gonna happen. This is kind of a fun game to play. Um, but Warren Buffett said stock market analysts' predictions exist to make fortune tellers look good. And I think that's what we normally see is no one really no one knows what's going to happen. Again, fun game to play, but I wouldn't be building my portfolio around these predictions.
Yeah, and the fascinating thing is they often project, mid single digits, high single digits, somewhere around that 10% return. They're projecting 11% for this year on average. And as we know, Peter, in terms of the history of the stock market, rarely does the market come in right around that. Not to say it can't happen, but in the average up year for the S&P 500 since 1928, the S&P is actually up 21% in the average up year. The average down year down 13.5%. So historically, been pretty rare to get to that 10% number that most of the time. I understand if you're going to pick a number, you would pick just what the average return is, but we've either seen strong up years most of the time or a down year for the S&P 500. No one is predicting that in that list, which is interesting to me.
Right. In our projections, we always use, you're going to get a 6% rate of return, an 8% rate of return, whatever it is. And to your point, the variance is much more, I think, than people realize. Very, very high returns in up years and double-digit returns usually in low years. Yeah, it works out to the average over time, but the ride is much more volatile.
For sure. And I just want to dig into why it's so difficult to predict where the S&P 500 is going to be on December 31st of a given year. There's two big factors. And if you could predict both of these right, Peter, you would be right 100% of the time. The first, of course, would be how much are earnings going to grow? And everyone thinks, if you ask Wall Street strategists estimates, everyone thinks earnings are going to be higher, but how much higher? And if we're looking at S&P Dow Jones, they're projecting 18% earnings growth in 2026. And there's all different projections. I've seen 14%, I've seen 10%. I haven't seen anyone say earnings are going to go down this year. It seems to be uniformly believing they're going to go higher. So you say, great, okay, I think earnings are going to go up 10, 15, 20%. Okay, that should be a good projection for what I think is going to happen with the S&P 500. Only problem, Peter, is this other side tends to be much more important than how much earnings grow in a given year is how much people change in terms of their optimism or pessimism, which means how much is the multiple on those earnings going to change. So we ended 2025 at 26 times trailing earnings. That's pretty high historically. The median since 1988 is 18 and a half times, but we don't know if that's going higher. It's been higher in the past, or it's going to get closer to that median level. We can't predict that. So I'm just showing you a table here, three different tables, one assuming 18% earnings growth that S&P Dow Jones is talking about, which would be $311 in earnings, 14% earnings growth, and 10% earnings growth. And you could see, depending on what you think that PE ratio is going to do over the next year, you can have wildly different S&P 500 levels. So if we do indeed, Peter, get that 18% earnings growth, it'll be pretty hard to have a negative return, I would say, for the S&P 500. You'd have to see a massive multiple contraction. But let's say it's only 10%. Well, now the numbers change. So it's such a wide range of possibilities here because it's such a wide range of possibilities in terms of what will happen to that multiple during the year.
Agreed. Lower rates are certainly going to help earnings. The economy's strong, but speaking of multiple contraction, we've had a multiple expansion of 25%. So at some point, we look at the returns of the market over the last decade or so. Part of that the majority has come from increased earnings, but a very significant part has come from multiple expansion. The question is, how long can that hold, especially with 10 stocks making up 40% of the S&P 500, where really it's a bet on their earnings, on their multiples holding, which is based on their earnings growing at a very, very rapid rate. And so, multiple expansion, can it expand much further from here? No. Can it contract? It will, most definitely. And the question is just when.
And it could contract, as you often say, Peter, and still get a positive return. So let's say we do
Yeah.
get that 18% earnings growth. S&P can go up 11% like these strategists are projecting on average and have a multiple contraction. It could go down to 24.4, right? So in terms of the year-end PE ratio. So you can have both of these things going on, strong earnings growth and multiple contraction. Why would that happen? Because people start looking ahead to 2027, right, at that point. So if they think 2027 is not going to be as strong of a growth year for earnings, they'll adjust that multiple at that point in time. All of this should tell you one thing and one thing only, Peter. It's impossible to predict where the S&P 500 is going to end of the year. So definitely don't make any investment decisions. It's fun to look at all these forecasts, but you don't want to be changing anything in your portfolio because of a prediction that someone is making about where the market is going to end the year. Let's go to the last question here. What will happen with tariffs and the jobs market? Just want to start out here quickly with tariffs, Peter. Year end, the effective tariff rate in the US was 14%. It started the year at 2%. And that 14% number had come down a lot from where it was, obviously, at the beginning of the whole tariff implementation. And maybe it's set to come down even more. The question will be, of course, one of a few things here. The Supreme Court is set to rule on the tariffs. Will they invalidate some of that? If they do, will that reduce some of the revenue that's coming in terms of we're doing about $30 billion a month in terms of the tariff tax revenue that's coming in? Will some of that have to be given back? Many different questions here, Peter, many different moving parts. The other moving part I think is a big factor is we don't yet really know what the ultimate inflationary impact will be because of the massive front running in tariffs that went on before the tariffs were implemented in 2025. We're just going to start to see that, I think, in early 2026. Overall, no one's talking really about tariffs anymore, which is pretty incredible. But what's your take on the tariff picture? Just more uncertainty this year in terms of how this is going to play out?
I think we're going to start to see these roll off. Maybe I'm being a little bit optimistic, but I think, it came out hot with Trump saying, hey, this is never going to change. Within weeks became clear we're going to negotiate. Then we entered into some deals, then it stalled. I do think we're going to see the great unwinding of all of this year as we finish negotiating some deals and try to get prices a little bit more under control, especially if we're going to be moving to the lower interest rates that he wants.
So ultimately, probably going to end up at a lower tariff rate than this 14%. That seems likely. That number, I'm even questioning that it's that high, because if you just look at the revenue that's been increased, it's not nearly been that type of increase in terms of we're doing about 30 billion a month. We were doing 7 billion a month. So the math doesn't add up. So we're not collecting all of it, or the actual tariff rate is lower than we're saying it is. Let's talk about the jobs market. I've called this the most confusing jobs market that I've ever seen. And I'm saying that because normally, Peter, when you have an increase in the unemployment rate from over 1%, like we've seen already, it was bottomed at 3.4%, very low rate in April 2023. And the last reading we got for last year was 4.6%, which is the highest we've seen since 2021. Normally, when you see a 1% increase in the unemployment rate every single time in the last 70 years, we've been in a recession already. So it's already different this time. Now you combine that with the fact that jobs growth is slowing here to 10,000 jobs per month over the last 4 months of 2025. A year earlier, it was doing over 200,000 jobs per month. This is with all the revisions built into that. Again, normally you would say we're in or headed for a recession. The problem is this time seems to be different. The big factor that I've been researching, looking at, seems to be the immigration factor. The big decline in immigration seems to be responsible for at least half of this reduction, and probably more. And we have this chart here of jobless claims, which doesn't match up with prior cycles of the unemployment rate rising. So while companies have slowed the rate of hiring, they're not yet doing the layoffs that they normally do during a recession. This number came out today. Initial jobless claims, lowest level since April 2024. Very confusing labor market, Peter. I know you talk to a lot of business owners. What are people saying? Is anyone talking about this being an alarming signal? What's your best guess for the labor market in 2026?
I think we're going to see it. I mean, you've got conflicting things happening here, and different people in different industries are worried about different things. So, people that are looking for low cost labor that was handled primarily by illegal immigrants, just to be, really frank, they're very, very concerned that they're going to have to pay a lot more, pay benefits, and so on, and that it's going to impact their pricing, make them less competitive. We see a big group of people in a lot of service type spaces, agriculture spaces, concerned about that. People in professional services and other professions like that, they seem to be very optimistic about AI replacing several layers of future employees, and they really feel like they're going to need less people, whether you're an architect or an engineer or an accountant or whatever, to get something done. And so I think we're going to have these two tensions. I think in the short run, we're going to see the immigration, the deportations and everything are going to tighten the labor market. And by the way, it's not really the deportations. I mean, at least as of the time of we're recording this, President Trump has deported far less people than, say, President Obama did. The difference is that less people are coming in. We're not seeing that has definitely changed. So less people are coming in illegally. So you have less of that cheap labor market. But I think this is going to get overwhelmed. I mean, that's the short-term pressure. I think it's going to get overwhelmed in the intermediate to long run by what AI is going to do. And I think it's really, really going to dramatically change the employment landscape in a way that I don't know that people are ready for. And we will start to see the unemployment rate uptick. Layer on top of all of that, just to make it more complex, we have the demographic issue. You've got the boomers, which is the largest generation that the U.S. has seen. I'm Generation X, but you've got these generations coming up that are much smaller. So we have less people to fill our schools and to take jobs and so on. And the economy is going to have to deal with that too. So these three different major impacts on employment, unemployment, and the question is going to be what's more powerful. At the top of the list, I would put AI. Secondarily, I would put demographics, and I would put as a distant third, but still very important, immigration.
Yeah, great summary there. We could probably do a whole show. Maybe we should just on that one question. There you have it. 6 questions for 2026. If you're in any of these cities in Q1, we're taking the show on the road again. We're doing our Connect events in Phoenix, Arizona, California, Austin, Texas, Indianapolis, Memphis, and Virginia. So join us at one of these events. I'll have a link in the show notes, creativeplanning.com/regional event. With that, we'll end it right there. Thank you, everyone, for joining us on Signal or Noise. If you're watching this on YouTube, take a quick moment and hit that subscribe button. We're also available on Apple and Spotify. And Peter, I will see you next time on Signal or Noise.